We're looking at the dollar index as our weekly chart here. And I want to take you into this candle here, mean threshold, that up close candle, bearish order block. You can see we worked up into that level here several weeks ago. You've known about this fair value gap here, and we have a liquidity pool right here for sell side liquidity. So we're in a bit of a trading range. So far we've had multiple instances of trying to get above this imbalance. Both times we've had an unwillingness to do that. Very short-term sell-side liquidity pool here, but a lot more resting below here. So it'll be interesting to see how we open and trade this week coming up. I'm favoring at least a run below this low, and how we trade there. Does it accelerate? If it does, then obviously we'll be looking for it to reach below here for the sell side. If we trade below it here and then reject, then we may stay inside of this range right in here a little bit longer. All right, so here's the daily chart on dollar index. You can see again how we worked up into that weekly mean threshold of the bearish order block. This shaded area doesn't look as clean. You'll notice the weekly fair value gap before we drop down into the daily chart, as you can notice up here. It doesn't look like a fair value gap on the daily chart. That's why you have to take your higher time frame PD arrays and transpose them into the lower time frames. We have a daily fair value gap here, and we see we worked into that level there, and now we had a really nice sell-off last Friday. This down close candle right here, I'm watching how we open on Sunday and we trade on Monday. Because we have this potential order block, we might again want to return back up into this area right in here. And the reason why I'm saying that is because we also have a high, low, higher high, which is a breaker. So it may want to come back up into this area here. And this entire down close candle is the bearish breaker. So we have to be mindful of that going forward. So, gun to my head, I favor a run below this low, and how we do, if at all, trade below that low. If it accelerates, then all this liquidity in here should be a likely draw longer term. Hourly chart on dollar index. Here's that weekly fair value gap here. And I have the holiday, 4th of July, highlighted here. Opening price. On Monday, New York midnight opening price. So we can see the weekly power 3, which is the open. If we were looking for shorts, obviously you want to see it rally higher. The Thursday, which is what I mentioned in commentary earlier in the week, that they would be more favorable, cleaner price action towards the end of the week because of the holiday on Tuesday, July 4th. Whether you celebrate July 4th or not and you're outside the States doesn't matter. The market's going to reflect that lower volume. So when we see this run here, it's occurring on Thursday. So generally, and I talked about this on my most recent Twitter space, the idea of trading Mondays and when not to trade Mondays, I covered that yesterday in about an hour and a half audio presentation on Twitter. And the normal procedure is we want to try to find ourselves before Wednesday of the week of non-farm payroll Friday. Because there was a holiday, and because of that being the case, I felt that we would have a lot cleaner price action on the latter portion, which would be Thursday and Friday. And I'm delineating that Thursday here at midnight, New York local time. And we see we drop down, return back into the Monday, New York midnight opening price. We rally, and also notice all the work around that price level here. A lot of respect of that. And then we have the Judas swing. We rip higher, take out the buy side here, and then we drop back down. Look at the bodies staying real close to the high of that weekly fair value gap. Remember, this pink area here is derived from the weekly chart. So this right here indicates, again, as soon as this candle closes and this one opens, rallies up and starts to trade lower, we can trust the fact that this high and that high here, all of this was a run on liquidity. So any rally up, we would just watch and see if it is held at bay kept from going any higher at the consequent encroachment of the high to the close of that candle. So it would be basically around the high of 103.421 thereabouts. And then the market works its way lower on the lower end of that weekly fair value gap, the pink shaded area. We hit it as resistance, and then sharp break below here. We open, come right back up for an immediate rebalance. That right there, as I taught you months ago, that immediate rebalance is very, very powerful. So if we had a move lower than that low here, this is all of a Judas swing. So that Judas swing there is indicative of manipulation, a stop run, and before a stop run, we have to have a bias. And if we were looking for lower prices and targeting this old low down here, using that old fair value gap on the weekly chart, the displacement below that low is on this candle right there. In the very next candle, we're opening up, rally back up to this candle's low. So there's no fair value gap. It's an immediate rebalance. When the market does that, it's going to be in a quick, hurry, sudden, urgent price delivery to get to a specific level of liquidity or inefficiency. So we can see obviously the liquidity would be over here, and it drops down aggressively for that during the non-farm payroll Friday. All of that again is the Judas swing. So weekly power 3, we open, rally up, make the high of the week, and then trade below, all inside of the latter portions of the week, Thursday and Friday. Zooming in onto a 15-minute time frame for dollar index. Again, here's that Monday New York midnight opening price. We extend that throughout the entirety of the week. We have a fair value gap in here. We trade up into that during the New York open, and it is the 8:30 non-farm payroll Friday report. We break down. Last up closed candles consecutively. That is a bearish order block. That closing in of that price point right there, rallying right up to it here perfectly to that opening price. This is the change in the state of delivery. The algorithm will refer back to that price right there, go right back up into it, drop aggressively for the sell side. Euro dollar, everything we would expect in the dollar index would be obviously reversed here. I've been calling your attention to this weekly volume imbalance for months now, and while we did retrace back down to this bullish order block, we rallied, created a fair value gap. We've had multiple times trading down into it. I told you we would want to see this area here act as an inversion fair value gap. That means to trade above it, find it as support, and then take into consideration the buy side, and then eventually up into the weekly volume imbalance. So if we do in fact get lower prices on dollar index, I really favor seeing us trade up into the 111, 111.30, 111.5, and how far we get into this weekly volume imbalance, we'll have to see that. But that's the longer term draw on liquidity. Gun to my head, I think that's what we're going to try to reach for. On the daily chart, here's those relative equal highs. It's buy side, and the weekly volume imbalance is above us there. Weekly fair value gap, and again, we're treating this as an inversion fair value gap. So I'm just again making reference to it here because it's a weekly PD array. But the logic is if we're looking for it to act as support. It doesn't need to come back down and touch it again. It's just something that I'd like to see, and if it does, it would promote the idea of maybe tape reading it or demo trading it. Last down closed candle is the bullish order block, and then we also had, again, dug into this weekly fair value gap, which is a discount. We'll be looking for a run up into these two premium arrays right there. Short term would be the buy side here. How we trade above that, again, think about what I said for the dollar index. It's short-term low for the dollar. How we trade below that would be, respective of this high here as well. We want to see it trade above it and aggressively move towards these relative equal highs. I don't think if we're going to bump these highs and then break them and then go lower. I think if we're going to go above there, we're going to trade definitely inside that weekly volume imbalance. So I would be a little leery being bearish on euro. All right, here's the hourly chart for euro dollar. You can see the buy side liquidity up here. Again, that weekly inversion fair value gap. And we have a buy side imbalance, sell side efficiency here. Extending that forward. See, we worked off of the daily bullish order block, which is that line right there. I made it a little bit thicker so that we can see it. And then we have this down close candle here, 60-minute bullish order block. And then we have this here. Now, what I'm annotating here is really a 2-hour order block. So this range from high to low, all of this right here will be encapsulated in a 2-hour order block. So 2 hours of time was a little bit longer term or larger order block, but I'm representing it on the hourly chart. So when I'm doing order block theory, I'm actually toggling through all the time frames, even time frames that are outside the normal range. Like everybody's familiar with the monthly, weekly, daily, 4-hour, 1 hour, 15-minute time frame, and then whatever it is below 15 minutes that you might like. I will look for multiple time frames in between the standard go-to time frames. And a perfect representation that would be is how I'm teaching you the intraday charts on like silver bullets and or the model 2022 on my YouTube channel. I'll take you down to a 5-minute chart. Then from 5 minutes, we drop down to a 4-minute, 3, 2, 1. And this year you've learned how I use even less than a 1-minute chart for a 30-second, 15-second, and 5-second chart interval. All of those ideas are a top-down approach. But order block theory really leans on the understanding of where we are in the price delivery continuum. So we can see we have a breaker here. Okay, and that's what specifically the order block is that's being referenced. And how is it a breaker? We have a swing low, swing high, swing low that's lower than that one. Relative equal lows, but inside of that range between high, low, and low, what do I have here? I have a order block, I have a breaker, and I have a buy side imbalance, sell side inefficiency. Any one of those PD arrays could be utilized for you. That would be your multiplier. I'm just annotating them that way you can see and decide which one appeals to you. Okay, but we can see we rally here, we open, trade down, hit the breaker, then rally. Really nice through the weekly inversion fair value gap, and I would have enjoyed seeing it trade back down into it just to touch it one more time, much like this right here did. It might want to trade down into that, but with this gap here, I would not want to see the high of that candle, which is the low of the BISI, buy side imbalance, sell side inefficiency. I would not want to see that, or consequent encroachment, which is half of this shaded area here. I would not want to see that traded through. Okay, so as long as we're above all that, I'm bullish on euro dollar. 15-minute time frame on euro. Okay, you can see again New York open on non-farm payroll Friday. We dropped down into the daily bullish order block inside of consequent encroachment of the buy side imbalance, sell side inefficiency. Again, before we drop down to the 15-minute time frame, it's that blue shaded area. Rewind the video. You'll see that this run into this, there's two PD arrays that are being hit. Consequent encroachment of the buy side imbalance, sell side inefficiency was that blue shaded area, and the daily bullish order block. So between that and add to it, if you want, you can use the last down close candle right in here. So order block, consequent encroachment of the BISI, and daily order blocks. There's a confluence of multiple things with inside the New York open kill zone, which is 7 a.m. to 9 a.m. New York local time, and the 8:30 news embargo lifting at non-farm payroll numbers. We rally up, then come back down, hit that breaker, rally, down close candle here. Even though we run away from it, we trade back down into it once more. That right there would have been a buy, and a rally, and then we have this gap here. So think about the midpoint of the shaded area here. As long as we're above that, we're looking for higher prices, more specifically aiming for buy side and or the weekly volume imbalance. E-mini S&P, here is the weekly chart, and we have a weekly volume imbalance there as well. I haven't quite got into it yet. We traded down about halfway of this down close candle here, so it's really important to see how we trade this week. I'm not trying to pick the top, but I like the idea that we stopped halfway in this down close candle here. We already traded into this inefficiency there, so I think this might just be a reason to retrace back into this range and then expand up into that weekly volume imbalance between this week and the next 2 weeks or so. We'll work inside that range. That's what I'm expecting. Obviously, all of that can change on Sunday's opening. I'm just giving you my forecast based on what we have here on a close basis of Friday and not knowing how we're going to open. There's all kinds of things that could obviously change it, where we open, how we trade Sunday going into Monday's opening. Daily chart here. Okay, you can see we just fell short of that weekly volume imbalance, and we have several things in here I'm looking at. We had the fair value gap here that we worked off of. We have a volume imbalance right there, and if we trade down once more, that coupled with this last down close candle, I wouldn't want to see anything below 4,400 on a closing basis. I wouldn't be uncomfortable for it to go right down there Sunday into Monday and then try to make another move higher. But until we take out that 4,400 on a closing basis, I don't want to try to pick a top on ES. So we could just bang around in here as long as we keep this order block intact. We're good. If we lose this order block, okay, this down close candle here, my attention goes right to this area right there. Okay, so this buy side imbalance, sell side inefficiency, 4,300 or so. That would be, if we take out that low, that's where we're going. But I don't see that yet, and I would favor, obviously a little bit lower into this volume imbalance, and then, if at all, trading into this candle's high. How we do that, if at all, will be helpful to me at that time seeing it. So it certainly looks heavy in here. Looks really like it wants to, it opened, rallied up, immediate rebalance. It could accelerate aggressively lower. But I'm trying to avoid, like I preach and teach to you all, I'm trying to avoid trying to pick a top. So this could easily just come right back up and make a higher high into that weekly volume imbalance, and then give up the ghost entirely and then go lower. Or accelerate to the upside. I'm right now waiting and electing to see how we open Sunday and how we trade overnight into 9:30 opening on Monday morning. So it kind of like gives you a wait and see motive that I'm adopting for this beginning of the new week. All right, hourly chart, S&P. Notice that we are on electronic trading hours. That will change as I go through the slides, because I'm going to teach you how to utilize both to get a better depiction of what price is actually trying to do. I like the idea that they have very, very smooth highs up in here. Fair value gap there. We rallied up into that fair value gap and then traded back down into the buy side imbalance, sell side inefficiency. So this is a SIBI, sell side imbalance, buy side inefficiency classification within the PD array category of a fair value gap. This is a fair value gap too, that's shaded in blue, but this fair value gap is a BISI, so buy side imbalance, sell side inefficiency, sell side imbalance, buy side inefficiency. What is it inefficient? Buy side. That means upside delivery. You see it go right up in there and hits it there. Once it fills that little area up with upside delivery and it leaves, it's fine. It's ready to go to another discount array or sell side liquidity. It's interesting to see that we didn't take out that low. So I'll be looking to see how we do that, if at all, on Sunday. I'd like to see it gap lower, trade up, hit the low of this buy side imbalance, sell side inefficiency, and then rip into the sell side liquidity here. If we accelerate to the downside, your attention goes right in here. Okay, so what I was mentioning on the daily chart, this is a much more refined area where sell side is residing. How far below those relative equal lows can it go? That gap right there. Okay, and if we accelerate through that, then obviously you have to look at below these lows, as I was mentioning on the daily. All right, so now we're going to get to a little bit more in-depth discussion about inefficiencies, gaps, and how to use this information. 1 hour chart now with regular trading hours. So the only thing I've done was take the previous amount of price data and toggle this little right from electronic trading hours to regular trading hours. And regular trading hours is where you're going to see the gaps from the previous session to where we open up the next day at 9:30. So at settlement price, previous day, and then where we open at 9:30, whatever the distance is separating the settlement price of the previous day and where we open at 9:30 New York local time, that's our opening range. Okay, so that opening range gap acts and performs in the same manner as we would expect a weekly volume imbalance. Okay, so when we look at price gaps like this, okay, I want you to think about how markets efficiently deliver price. Okay, I taught this analogy using a paint roller. Okay, and imagine this white shaded area background is a wall in your house, and you want to paint in these little areas where you need to have paint applied. Okay, so maybe you've already painted your house and the paint's now faded, or there's handprints like a child. Like I had 5 kids, and obviously they would put their hands on the walls and make marks and such, and we'd have to have the walls painted. And some kind of blemish or some kind of inefficiency in paint exists between these two candle bodies. Okay, this candle's body here and this candle's body here. Between that opening price and that opening price, there's a separation of price delivery that did not have a body. So I'm highlighting that and extending it all the way through. When I show you these ranges, I'm not going to drop down to the lower time frames. The homework assignment for you is to have these on your charts and then drop down to lower time frames on electronic trading. Okay, so just know that I'm showing you something so that way you can observe and identify things and discover it on your own and have that aha moment. But this distinction here between these two candles opening here, there's no bodies between these two price points. So that inefficiency, you want to extend those out in time because they'll eventually be offered buy side and sell side. That means upside and downside delivery. Here we only had a partial delivery of upside and then drops. So from this point here up to here, that is the real inefficiency that remains because we've already had this partial and this movement down. So think of it as a paint roller, up and down. So from this opening price and that opening price up to right there, it has been offered delivery of price. So there's a real separation between this high and that candle's opening price. There's a distinct inefficiency there. But nonetheless, you can see how we respected that opening price there. Look how we're treating it with these bodies here. And then we have another gap there. We have a gap here, but I'm showing you how inside this range, you're anticipating and expecting price to deliver both sides, up and down. That's an efficiently delivered price. You can see how we worked off the low here, and we had another gap there. So it wants to reach up into that. But every time I'm showing you one of these ranges, I want you to go into not regular trading hours, but electronic trading hours and study how price delivers. You'll see how it's real dynamic support and resistance. It's not readily understood or seen by most traders. I mean, obviously I've been teaching it this year, but you won't see it in books, okay? You're going to look at it right away and think it's supply and demand, or it's classic support and resistance. I promise you there's no books out there with support and resistance with this idea. It isn't there, okay? They may see a gap, but they're not looking at gaps multiple times in the future, okay? And as soon as price would go from here to here, they would consider that gap closed and there's no more concern about it. And that's what separates me from retail. Because the fact that gap was created, the algorithm will refer back to those 3 price points, which is the low, consequent encroachment, which is the midpoint of the gap, and then the high. Okay, so whatever the extreme boundaries, high and low, and whatever the middle point is, those 3 specific price points are very, very sensitive. And if you want to go 1 degree beyond that, you can split that range up in quadrants. So the first 25%, 50%, 75% of the entire inefficiency, and then the high of the inefficiency. And that's what I want you to do for your electronic trading hours study. So look at all of the price action in here. Even though there's gaps missing, price data here, in electronic trading hours, there is no gap. It's actually being traded through from here to here, and then from here to here. So that's one there. The other one is here. Okay, and what you're doing again is toggling it from regular trading hours to electronic trading hours, and you'll study how price delivers inside this range here. You don't want to have all of the inefficiencies on the chart at the same time, so that way it helps you track what you're looking for and study time of day. Look for inefficiencies. Think like silver bullets in the London session, in the New York session, both AM session and PM session. You're going to be surprised to see how much precision that these levels will offer. Not just the high and the low, but consequent encroachment and 75%, 50, and 25% of those respective ranges. And then lastly, the one here. Okay, so that way you can see these are 3 homework assignments I want you to go through on your time frames lower than obviously the 1 hour chart. And you'll see that these respective inefficiencies have really interesting characteristics where setups can form. All right, 15-minute time frame. I taught in the One Setup for Life tutorial on my YouTube channel. It goes over how to classify specific liquidity pools and how I break down the days and look back at very specific points of liquidity. I mentioned the London session highs and London session lows. We have a sell-side liquidity pool here. Thursday, New York PM session buy-side liquidity, London session buy-side liquidity, sell-side here. That would be the London session for this day here. And at 9 on payroll Friday, we open up, rally up, take the buy side here on the Thursday New York PM session, and then we rip lower to take out the London session sell side liquidity. Then we rally up one more time, trade back down to a bullish order block, and then rip higher, attacking the Thursday London session buy side liquidity pool. Then in the afternoon, we reverse course and go all the way back down to attack the rejection block and the original sell side liquidity pool. It was interesting to see it not take out that low. So I think it has unfinished business going into Sunday's opening. So again, I'd like to see us open lower, to gap lower, and how we trade lower, if at all, below that low. Just be mindful, this little tiny gap here. It might give you a run down there, go into this gap and then rip higher and defer a run below that low if it's going to do it. Or if it does break lower, it can just be a quick sudden run. But I just want you to be aware of that little gap right there. In the event that should we start running for this low, this could be one of those little speed bumps that cause us to pull back up into the range, and then at a later time take that low out. So it's a matter of wait and see how we trade on Sunday's opening price and into Monday. All right, 5-minute chart on E-mini S&P. Same respective liquidity pools annotated here. Okay, you can see a nice order block trading into it here. This is a classic optimal trade entry trade as well, and it starts to accumulate and rally higher, tearing into the Thursday London session buy side liquidity, and the market reverses. It breaks down. I did longs all through here on NASDAQ, and then I shorted it going into the PM session on NASDAQ. So I didn't do any work on S&P here. Here is the regular trading hours on a 5-minute chart, and taking us back up in this low here. Now, why am I using this low and not the closing price here? There's a specific pattern here. If you are a student of mine that have been with me for a while, you know what this pattern is. I'll give you a second. I'll talk about something else. I'll come back to that in a minute. But here's the Thursday London session buy side liquidity. It rallies up into that and then trades up into that low here, and then starts to break lower and aggressively moves towards the relative equal lows down here. So this is a classic ICT market maker sell model. So we have accumulation, reaccumulation, smart money reversal, low risk sell, distribution, redistribution, second stage distribution basically, and an aggressive sell off into sell side liquidity. This pattern over here is a breaker. Okay, so it's a high, low, higher high. So you always want to refer to that, even if there's a gap like this. If there's ever a breaker there, always give the opportunity to see if the market will respect that. Not so much this one here, because this is an opening range as well. So where we closed here and when we opened down here, you would have that shaded. So extending it in the future, you can see we dug up into that as well. Again, you would note the opening and the close respectively on these two candles and extend that range forward. Okay, and you can see that's what we basically did here. We stayed inside that range, and then we gapped down here. So that gap, that huge inefficiency, you don't want to just go right back to the previous session's closing price, where I like to usually do that if we have a breaker. A breaker will many times disrupt that total closure of the gap. So how do I know certain gaps won't entirely close? There are certain things, obviously, that I've already taught you. This is another one here. Okay, so if there's a breaker inside the range that would be considered for a gap closure, you want to consider where that down close candle's low is. And you can see we have respected that here. All right, 1 minute chart. S&P, you can see we have a higher low, and NASDAQ we have a lower low. So I elected to go with the NASDAQ simply because I had some students asking me, why am I only doing S&P? Can I do something with NASDAQ? So I went into NASDAQ and I basically beat it all up. I went long in it and then I went short in it. I didn't get the last whole run lower on the PM session. I did explain it in a recording, and you can watch me do live executions in a video on my YouTube channel for Friday's PM session for NASDAQ. I show all the executions on the upside, and I did some live executions in management on the lower end for the NASDAQ. But I mentioned how I felt it. It could go lower, but I didn't have the time to be able to spend managing the entirety until the close. But a really nice run into a lower low here, higher low on S&T divergence for S&P. S&P rallied higher. NASDAQ followed suit, and then we have a disruption up here. So we have short-term low here, which helped me time the potential intermediate term high. I did try to take a trade, and I'll go into this here. But the idea was that the S&P doesn't really have a clear swing low that would be clear when we drop lower, but the NASDAQ does. So I mentioned it in one of the recordings I placed on my Twitter feed. And once I knew it was running in my favor, I was like, okay, well, I already know what this is. This is a market maker sell model. And all of this consolidation, it would want to go below these relative equal lows. And we saw that actually happen here. But canceling this rejection block in addition to all this here. So that would be a nice area for sell side liquidity. You can see we did, in fact, reach down into it. For silver bullets between 10 o'clock in the morning and 11 o'clock in the morning, New York local time, we have a fair value gap there after hitting an order block and fair value gap there. We rally higher, trade back down in, silver bullet, run for relative equal highs. So buying here and getting out there just at that high here, that's enough for a trade. You don't even have to hold on to any of this up here. In the PM session, silver bullet, same idea, this is in reverse. We had consolidation. So when you take a silver bullet, if you're seeing consolidation like this, have this in your notes. Wait for displacement. We see that here, very energetic drop. Fair value gap, sell short there, and again, reach for 5 handles minimum. And if we had this area down here for a buy side, it will many times want to offer a redelivery to that as well, because every old liquidity pool acts like an inefficiency. It'll many times revisit it and act as the opposite. So if we were seeing buy side as a draw here, the algorithm will refer back to this area here and draw back down into it. But it has to be some measure of why it was drawn to for buy side. It's not just simply resistance, resistance, broken turn, support, because notice it didn't do anything for support. So I've already canceled that idea. You're already thinking, oh, he's just talking about support and resistance. No. There's a manner of taking this information and really understanding what would be support to buy or a target for a draw on liquidity. So again, I have a lot of lectures that will come that describe how to do all this stuff, but it can't be taught obviously in one sitting. There's a lot of things that are at my disposal, and I want to make it available to you, but everything a little bit at a time, because it's already probably too much for most of you. Hope you found something in this that was insightful and helpful, and until I talk to you next time, be safe.